We saw pressure on some U.S. lenders yesterday, including Zions Bancorp. Investors are worried about risk in the credit sector. Zions disclosed it would take a $50 million U.S. loss in the third quarter on commercial and industrial loans. However, investors were encouraged somewhat to hear that U.S. President Donald Trump wants to cool down this trade war with China. Let's get perspective from Brian Szytel, Co-Chief Investment Officer at the Bahnsen Group. Brian, thanks very much indeed for joining us. So I guess we do have these two cross currents, although last time I looked, Zions Bancorp was up in the pre-market, but there are these credit worries hanging over the market.
That's right. And in the grand scheme of banking, a $50 million loan write-down is a big deal for Zions, but ultimately not really all that big in terms of aggregate dollar amount in a big system. So, but you're seeing some of these cracks in the dam. You've got some of these loans that have defaulted. You've got a couple of company bankruptcies with First Brands, and some of those things are just reverberating through financial stocks. The idea that we would have interest rates go up from 0 to 5% in 3 years and not have any pain felt in banking, I think is, if this is all we're going to feel, in other words, I think everything's just fine. Most of the earnings coming out of the financials have been really quite good, frankly.
And the White House seems at pains to reassure investors and consumers that we don't plan to go on with these sky-high tariffs on China.
Ultimately, China produces something that we just don't have in the United States or in North America in volume, which is rare earth minerals. It is their leverage point. We have, of course, ours as well as the world's largest economy. And there's a negotiation going on. But ultimately, I agree. I think that they'll come to a decision and have some sort of reasonable settlement around it. Neither party wants a situation in which trade halts or something like that. And I think the worst case outcome really has been taking off the table here. And so markets have been moving around it, including a little bit of a rebound this morning, marginally. But that's where we're at with it.
You say the market is not particularly cheap. Stocks at around 24 times earnings, and bonds, there's a lot of optimism in the bond market. We've heard, for example, of narrow spreads on corporate debt to government debt.
Exactly. And you've actually seen spreads, at least high yield spreads, come out here a little bit, but 20 or 30 basis points, given some of the rhetoric heat up between US and China, given some of the financial issues that we've spoken about on the lending side and on the bankruptcy side, but that's not very much. If you're still at a 310 wide over treasuries on high yield spreads, that's a fairly rich market here. And then the same thing on equities. When you're looking at multiples of 23 times forward earnings, it's just expensive. And so I think it's time to really be selective and go inside of the indices and pick out sectors and individual names that make sense versus just owning the broad indices and hoping it continues to go higher.
One suggestion you have for investors is to seek out stocks that are in companies that are increasing the dividend.
Exactly right. I think if you look forward, high valuations in markets that have run up is not a predictor in the short term of where they'll go or anything like that. Okay, so short term is not really what I'm talking about. It's more over the next 3 to 5 years. When you look at returns being fairly muted, likely because of where valuations are starting, I think a higher level of income that is tax efficient, that is growing along the way, is going to produce more of a higher percentage of your total return going forward. And that's where we like to play.
You have a few stock suggestions for us. The first one, Moelis or Moelis, MC. Remind us what they do and what draws you to this name.
M&A and investment banking. What draws us to this name is Moelis has done a very good job in acquiring top talent. We had this really dearth of activity post 2021. Interest rates went to zero, obviously, then, and this was post-pandemic. And there really just wasn't any IPO activity, mergers and acquisitions. There wasn't a lot of deal making happening during that period of time. They were really good at picking up top talent from other firms. And now, if you think about some of those things heating back up, we've seen that in the IPO market. We've seen more mergers. We've seen more acquisitions, leveraged buyouts and such. Moelis is a perfect spot to capture that reward. And we think they're in a great spot. And you've got a stock that's down here a little bit year to date. So there's a value play and a nice attractive dividend with it as well.
Moelis, a global investment bank that specializes, well, one of its specialties, mergers and acquisitions. And certainly, what about IPOs? Do they get involved in that? I guess they maybe in a tangential way anyway.
Yeah, adjacent. And so all of that, and actually we have other exposures in the financial sector that would be probably more akin to taking advantage of the IPO market, call it Morgan Stanley or some of the bigger wirehouse brokerage firms. But nonetheless, having M&A be a zero and having it go something higher than zero over the next year or two is really where the value is. It's not asking for a lot. Those stocks have actually performed quite well. And again, you're getting a nice rise in cash flow in the form of dividend while you wait for that to pick up.
Right. Yeah, we're looking. I don't have the yield to hand on Moelis right now, but hang on, give me 1 sec. Yeah, almost 4%. Sorry. Yeah.
Almost 4%. Yeah. Almost 4%.
Okay. A name that also appeals to you, Chevron.
Chevron, in the broad energy complex, when you look at oil being, WTI today is at 57, Brent is 61. Who would have thought if we went back in time 10 years to 14 and 15, 2014, 15, 16, that you'd have oil come down the way that it has on the commodity price level and just have these stocks really hang in there. Chevron is roughly even on the year. It might be down just slightly, but you're getting a very attractive dividend yield, 4.5+%. You're getting an integrated company with up, mid, and downstream. You're getting a global franchise. You're getting a large exposure to natural gas, which we like a lot, particularly in the realm of energy production surrounding some data center build out and AI. And so it's a culmination of all those things. If you get oil going from 55 anywhere north of that, I just think it's a spring that's been compressed where you get some upside out of it.
And then finally, Blackstone, you reckon it's a fee-based machine?
It is. So the best of what capital markets is, best of Wall Street, exists within Blackstone. It's the largest owner of real estate, and it is poised to do well over time for those reasons. But it's out of favor. The entire sector in the investment landscape has been out of favor, even though we've got record high markets. And I think as interest rates come down here a little bit, and you don't get a credit event, if you're going to go through a period of time where rates come down a little bit, no credit event to speak of, maybe no deep recession, something like that. There really isn't a way for Blackstone to not produce a very steady stream of fee income to support that rising dividend stream. And you're getting a high two-handle yield in the meantime as you own essentially the best franchise on Wall Street.
Thanks very much indeed, Brian. Really appreciate it.
Thank you. Have a good weekend.
Brian Szytel of Bahnsen Group.